In the realm of personal finance, your credit score serves as the architectural blueprint that shapes your financial opportunities and challenges. Just as a well-designed blueprint can lead to a sturdy, efficient building, a strong credit score paves the way for a secure financial future. But what happens when the blueprint has flaws, or worse, when you don't understand it? The consequences can be as severe as a building collapsing. This is why in this video, we aim to demystify the enigma of credit scores, revealing not just the pitfalls to avoid, but also the powerful steps you can take to build a future of financial freedom. What is a credit score? A credit score is more than just a number. It's a financial passport that opens or closes doors to various opportunities in your life. Think of it as a grade that reflects how well you've managed your finances. It's calculated based on the information in your credit reports, which include your payment history, the amount of debt you have, and other factors. Your credit score tells potential lenders how risky it would be to lend you money or extend credit to you. But interestingly, your credit score isn't just for lenders. Many employers now check credit scores as part of their hiring process, especially for positions that require financial responsibility. A low score can be seen as a sign of poor financial management, which could lead you to missing out on job opportunities. Additionally, some landlords check credit scores when renting out property. A low score could mean you'll have to pay a higher deposit, or might even disqualify you from renting certain properties. Your credit score can also affect your insurance premiums and even your utility deposits. Now you might wonder, who's behind these scores? There are several credit scoring models out there, but FICO is the most commonly used. FICO stands for Fair Isaac Corporation, the company that developed the first credit scoring system. Another scoring model you might come across is VantageScore, which was created as a collaborative effort by the three major credit reporting agencies, Equifax, Experian, and TransUnion. Your credit score isn't static. It changes over time as your financial behavior changes. For example, if you pay off a chunk of debt, your score could go up. Conversely, if you miss a payment, it could drop. But we will get to that in just a moment. Right now, let's focus on how to find out your credit score. By law, you're entitled to one free credit report from each of the three major credit reporting agencies every year. While these reports won't typically include your credit score, there are various ways to obtain it, often for free through financial institutions or other services. Credit score ranges. Understanding credit score ranges is like knowing the grading scale before taking a test. It gives you an idea of where you stand. The most commonly used credit scores like FICO and VantageScore usually range from 300 to 850. But what do these numbers mean in practical terms? If your score is between 300 and 500, you're in the very poor range. This is the financial equivalent of being in the emergency room. Immediate action is needed. Lenders are likely to see you as a high-risk borrower, and you may find it difficult to get credit at all. If you do, the terms will be unfavorable, with high interest rates and stringent conditions. Scores between 500 and 580 are characterized as poor. While not as dire as the very poor category, this range still signals to lenders that you're a risky bet. You might still qualify for some loans or credit cards, but expect high interest rates and less than ideal terms. The fair range spans from 580 to 669. If you're in this category, you're in a sort of financial purgatory. You're not quite in the danger zone, but you're far from safe. You'll likely qualify for credit, but not at the most favorable terms. It's a wake-up call that you need to work on improving your financial habits. A score between 670 and 739 is considered good. This is the financial equivalent of getting a B in school. You're doing well, but have room for improvement. Lenders are likely to offer you credit at moderate interest rates, and you'll find doors opening for you in terms of financial opportunities. Scores between 740 and 799 are very good, akin to getting an A in school. You'll enjoy lower interest rates, higher credit limits, and more favorable loan terms. You're seen as a low-risk borrower, which can save you a lot of money in the long run. Finally, if your score is 800 or above, you're in the elite excellent category. This is the financial equivalent of graduating summa cum laude. You'll get the best interest rates, the highest credit limits, and lenders will practically roll out the red carpet for you. Understanding where you fall in these ranges can help you set financial goals and take steps to improve or maintain your credit score. It's not just about getting credit, it's about getting the best terms possible. For example, if you're taking out an auto loan, a lower credit score could mean you'll pay significantly more in interest compared to someone with a higher credit score. This difference in interest rates can be substantial over time, affecting not just your immediate finances, but also your long-term financial planning. This is why understanding what lowers your credit score is the first step towards financial literacy. While late payments and maxed-out credit cards are common culprits, there are other factors that can negatively impact your credit score. For example, having a high credit utilization ratio, which is the amount of credit you're using compared to your total available credit, can lower your score. Experts often recommend keeping this ratio below 30% to maintain a healthy credit profile. Another aspect that can lower your credit score is a thin or short credit history. Lenders prefer borrowers with a longer history of responsible credit usage. If you're new to credit or haven't used it in a while, this can work against you. Additionally, applying for new lines of credit in a short period can also be detrimental. Each application results in a hard inquiry on your credit report, and multiple inquiries can lower your score. Your payment history is the most significant factor, however, accounting for about 35% of your FICO score. This includes not just credit card payments, but also retail accounts, installment loans, mortgages, and certain public records like liens and bankruptcies. The more late or missed payments you have, the more your score will suffer. While the said actions do harm your score, they're nowhere near as detrimental as having bills sent to collection agencies, being evicted, declaring bankruptcy, losing a home through foreclosure, or having a court judgment against you. These actions can stay on your credit report for up to 7 to 10 years, making it extremely difficult to secure loans or get favorable interest rates. So what we want is for you to think of credit score as the financial version of the butterfly effect. A small change can lead to significant impacts. A few points up could mean the difference between a dream home and settling for less, or between landing that job offer and getting a polite rejection email. But here's the intriguing part. Your credit score isn't set in stone. It's a dynamic, living entity that you have the power to change. If you liked this video, please consider subscribing and sharing so we can keep bringing more content like this. See you next time!